Nvidia's stock price recently soared due to in May this year, at Nvidia's 2024 first quarter earnings conference call, it projected the second quarter revenue to $110 billion, while analysts initially only expected $71 billion. Before Nvidia made this astonishing forecast, according to the original growth rate estimated by analysts, Nvidia was expected to reach $110 billion in quarterly revenue by 2026, meaning Nvidia pulled forward the timeline by 3 years. It's natural for the stock price to soar as a result. However, in the past couple days, a line of thinking has spread widely on social media. Was Nvidia's surge in revenue achieved through a shell company faking increased revenue? This video will take a closer look at what actually happened. Hi. You are watching FOMO Cheetah. After Nvidia's $110 billion quarterly revenue forecast, its actual second quarter revenue in 2024 even exceeded the previous forecast, reaching $135 billion, meaning Nvidia's year-on-year revenue nearly doubled. But this raised doubts. How did Nvidia manage to double its revenue while keeping sales costs basically unchanged? Logically speaking, selling more chips should also lead to corresponding increases in sales costs. There's an even more suspicious company, called CoreWeave. In August this year, it obtained a $2.3 billion loan from Blackstone, using Nvidia's H100 GPU chips as collateral. Coincidentally, CoreWeave obtained a $220 million Series B funding in April this year, with one of the investors including Nvidia. The starting point of Nvidia's stock surge was also the CEO of Nvidia forecasting the $110 billion second quarter revenue was due to surging demand for generative AI and language models, which will bring huge growth to data centers. As it happens, CoreWeave is a data center company. Connecting these dots forms a terrible theory. CoreWeave was backed by Nvidia, who invested $2.3 billion in Nvidia chips. Using these $2.3 billion worth of chips as collateral, CoreWeave obtained a $2.3 billion loan from Blackstone. At the same time, Nvidia's financial report saw a sudden surge in revenue. Then, CoreWeave can use the $2.3 billion loan from Blackstone to buy more Nvidia chips. One thing needs clarifying. There was a typo in the original tweet, where it said CoreWeave obtained the $2.3 billion loan amount from BlackRock instead of Blackstone, but it's not a complete mistake because BlackRock was also involved in this loan process. While the year-on-year comparison does look suspicious, if we track Nvidia's quarterly financial reports over the past year, the overall trend is much clearer. From the second quarter of last year, when revenue was $6.7 billion and cost of sales was $3.8 billion, to the third quarter when revenue fell to $5.9 billion and cost of sales also declined to $2.75 billion, gross margin improved from 43% to 54%. Since then, Nvidia's gross margin has continued to improve to 64% and recently 70%. This explains the apparently strange phenomenon from only comparing year-on-year data of revenue doubling while cost of sales remained basically unchanged. Nvidia's improving gross margin over the past year is mainly attributable to the increasing proportion of data center revenue. The GPU chips that CoreWeave used as collateral belongs to data center revenue. How valuable are these chips? Estimates suggest Nvidia's cost to produce an H100 GPU is only $3,300, but it can be sold in the market for $25,000 to $30,000, meaning a profit margin as high as 1,000%. So who is CoreWeave actually? It was founded in 2017 during the initial crypto mining boom. CoreWeave initially purchased GPU chips for mining, but quickly pivoted to data centers when the crypto winter hit. That's when the money started flowing in steadily for Magnetar Capital. In November 2021, Magnetar invested $50 million in CoreWeave. In December 2022, another $100 million to expand data center scale, i.e. buying more GPU chips. In April 2023, there was the aforementioned $220 million Series B funding led by Magnetar. Finally, the chip collateral financing with Blackstone and Magnetar provided CoreWeave another $2.3 billion loan. This series of operations can be said to have major capital maneuvering. But it's also hard to say it's completely wrong. For Magnetar as the initial angel investor backing CoreWeave, it needs to bring in more investors so CoreWeave can grow rapidly and profit in the shortest time. Using Nvidia chips for financing to buy more Nvidia chips is also not illegal, as long as CoreWeave's expanded data centers have real market demand rather than simply being a shell company to artificially inflate Nvidia's revenue. Microsoft has also signed contracts with CoreWeave to use their data centers and Nvidia's GPU chips to ensure OpenAI has sufficient computing power. However, CoreWeave's approach does carry risks. Assets used as collateral are most afraid of depreciating in value. Currently, the scarcity of Nvidia GPU chips seems to be taken as maintaining asset value. Additionally, with H100 GPU orders backlogged until 2024, CoreWeave was clearly specially treated to obtain chips in priority, and a considerable part of those backlogged orders may very well be from CoreWeave using chips as collateral. CoreWeave naturally wouldn't want H100 GPU prices to fall. With Nvidia also investing in CoreWeave's background, this operating model relies on Nvidia maintaining its current monopolistic position. Based on the information so far, there is no evidence that CoreWeave or Nvidia have committed any outright fraud. The suspicions raised may be due to some data points looking unusual out of context, without considering the overall industry background. The application of artificial intelligence is growing rapidly across many sectors, especially in data centers, healthcare, automobiles, and more. These industries have immense demand for AI chips. As the leading provider of AI computing power, Nvidia GPU products like the H100 are in high demand already in these fields. CoreWeave would naturally be a key customer of Nvidia's advanced GPUs. Given the tremendous growth in AI demand, it makes sense that CoreWeave would make large purchases of Nvidia chips to expand infrastructure. This better explains why CoreWeave could use a large amount of Nvidia chips as collateral to obtain major financing. Meanwhile, the booming AI industry also helps explain why Nvidia's recent revenue has increased quickly and gross margins improved steadily. While the year-over-year numbers superficially look odd in isolation, they don't appear overtly unreasonable when put in broader context. Overall, without stronger evidence, we shouldn't be too quick to suspect CoreWeave or Nvidia's business activities. The huge market demand unleashed by the AI wave is likely the primary underlying factor driving their good performance. I'm open to revising my viewpoint if further investigations uncover new information. But for now, this issue merits an open-minded and tolerant approach. Alright, if you enjoyed this video, smash that like button and consider subscribing if you haven't already. Share your thoughts in the comment section below. Thanks for tuning in to FOMO Cheetah. I'll see you on the next one. Cheers!